This question tests knowledge of IAS 36 impairment of assets, specifically how to distinguish between external and internal indicators of impairment. Under IAS 36, an entity must assess whether there are any indicators that an asset may be impaired. These indicators are classified as external indicators, arise from outside the entity, market conditions, economic environment, interest rates, asset prices. Internal indicators arise from within the entity, asset usage, obsolescence, physical damage, performance issues. The question requires identifying two external indicators, so the key is to focus on factors driven by the market or economy, not the entity's internal operations. Unusually significant fall in the market value of assets, correct. This is clearly an external indicator, as market prices are determined by external market forces. A sudden or unusual decline signals possible impairment. Evidence of obsolescence of one or more assets, incorrect. Obsolescence is an internal indicator, usually arising from technological changes or how the entity uses the asset. Decline in economic performance of assets, incorrect. This is also internal, as it relates to how the asset is performing within the business, e.g., lower productivity or output. Increase in market interest rates, used in discounting value in use, correct. This is an external economic factor affecting discount rates and reducing recoverable amount, therefore indicating potential impairment. Correct answers: unusually significant fall in market value, increase in market interest rates. Exam tip: always classify indicators into external equals market, economy, interest rates, prices. Internal equals usage, damage, performance, obsolescence. This question tests knowledge of IAS 36. Impairment of assets, specifically the distinction between internal versus external indicators of impairment. The key requirement is to identify internal indicators, which arise from the entity's own operations or asset usage, rather than external market conditions. IAS 36 requires an impairment review when there are indicators that an asset's recoverable amount may have fallen below its carrying amount. These indicators are grouped into external sources, e.g. market decline, economic changes; internal sources, e.g. usage, performance, physical condition. The question asks for two internal indicators, so careful classification is essential. Market value of the asset has fallen significantly. This is an external indicator, as it relates to market conditions outside the entity's control. There are adverse changes to the use to which the asset is put. This is an internal indicator because it relates to how management uses or deploys the asset, e.g., change in production method, reduced capacity usage, or reassignment. The asset is fully depreciated. This is not an impairment indicator under IAS 36. An asset being fully depreciated only reflects accounting allocation, not recoverable value. The operating performance of the asset has declined. This is an internal indicator, as it reflects reduced efficiency, lower output, or poorer cash generation from the asset itself. Correct answers: adverse changes to the use to which the asset is put. Operating performance of the asset has declined. Students should remember, internal indicators equals how the asset is used and performs inside the business. External indicators equals market and economic environment changes. This question tests IAS 20, accounting for government grants, specifically how grants related to assets are recognized and presented in financial statements. The key issue is understanding the two permitted approaches for capital grants. Government grants related to assets must be recognized in a way that matches the benefit of the asset over its useful life. IAS 20 allows two acceptable presentations. 1. Deferred income method. 2. Deduction from the carrying amount of the asset. Students must identify which treatments are compliant and reject those that incorrectly affect profit immediately or misstate asset values. Set up the grant as deferred income correct. This is the deferred income approach. The grant is recorded as a liability initially, and then released to profit or loss over the asset's useful life. Matching income with related depreciation expense. Credit the amount received to profit or loss incorrect. This is not allowed for asset-related grants at initial receipt because it would overstate profit immediately and violate the matching principle. Deduct the grant from the carrying amount of the asset correct. This method reduces the asset's carrying value directly. Consequently, depreciation expense is lower over time, spreading the benefit indirectly through profit or loss. Add the grant to the carrying amount of the asset incorrect. This would inflate the asset value and depreciation, which contradicts IAS 20 requirements and distorts financial reporting. Correct answers. Set up the grant as deferred income. Deduct the grant from the carrying amount of the asset.